Hello, everyone, and welcome to the BP Learning Channel. Today, we are here to talk about how to quantify expected results in a business plan, part 2 of a 2-part workshop focused on a dynamic business planning and measurement process that will help you maximize business performance over the long haul. All part of the Value-Driven Ownership Program called VDOP. We will be using a free spreadsheet template to do projections, and when we are done, you will have some powerful performance measurement reports going out 5 years. Information you can use to launch, grow, and exit a business with a healthy profit. I'm Debbie, a certified SBDC coach at the Business Incubator Center, a partner with the Colorado Small Business Development Center under the SBA. I am also a former business owner myself, a former CFO for multiple startups in the Silicon Valley, and a CPA with a master's in finance. In today's session, we will focus on business planning. We will talk about business viability again, only this time we will focus on how to quantify expected results. We will put some serious numbers into your business plan using a strategic planning tool, a real-time projection model that gets updated on a rolling basis, at least once a year, with quarterly reviews and adjustments as required. You should schedule these events to make sure they happen. The model we will be using today includes profitability information for 5 years, monthly for 2 years, and annually for 3 years, expected rates of return, break-even levels, competition benchmarking, and a range of value for your business. It's designed to be a management tool that makes you pause every once in a while to reevaluate your current operations. Let's get started now with a break-even analysis. We need to answer 2 questions in this regard. Can I break even and grow? And how much money do I need from operations to tip the scale to a break-even point? Can I pay myself $50,000? That doesn't seem like much. Can I pay my debt of $200,000? That's a lot. And can I pay my investors $150,000 with some kind of rate of return? That's a lot also. Can I pay my employees enough money to keep them happy? How much money do I have to make in sales to make all of this work? How in the world do I figure all of this out? Well, we have to do a break-even computation. What does that mean exactly? It means we have to do some math, 3 computations, and learn a new financial term. Let's start with computation 1, a personal budget for owners, something we should all be familiar with. We take whatever income owners have outside of the business, maybe a part-time salary or rental income from property they own, and we subtract required living expenses to get to a minimum budget. The minimum amount your business needs to make to cover your personal expenses. In this case, the number is $8,027, the break-even point. Next, let's talk about computation 2, free cash flow, most likely a new term for most of you, but a very common term in the Silicon Valley. So let's make sure you know what this means. Free cash flow is equal to revenue minus operating expenses or net profit, excluding depreciation because that's not cash. Instead, we subtract capital expenditures, money out of the door for things like equipment and vehicles to get to free cash flow. The important thing to remember here is that capital expenditures is real cash out the door, and this replaces depreciation. At this point, you can already see that free cash flow exceeds the minimum budget, but it doesn't happen until year 3. Let's take a look at computation 3, cash over or short. It happens when free cash flow of $16,129 minus the minimum budget of $8,027 equals a positive number. In this case, $8,102. That's what break-even is all about. And that's where you should start in a cash flow projection. Okay, that's enough about break-even. It's time to talk about other assumptions, estimates, educated guesses about the future that are the foundation of any projections. And you need a good foundation to tip the performance scale in the right direction. A foundation based upon historical results, if your business has been up and running for more than a year, and industry knowledge. Historical results are important. You should consider trending of revenue and expenses. Remove anomalies. Maybe calculate some averages. You should also look at significant changes in your business, such as new products, new services, new locations, and eliminations of profit centers or product lines. Industry assumptions are based upon your experience in the industry, in-depth research and monitoring, and conditions in the local and global economic environment. Importantly, you need to document your sources of information. Sources like this provides credibility. Investors and bankers will have more confidence in your numbers, and documentation will help you in the future when you update your work. And now, let's talk about how to measure your business performance. It's all about understanding and using something called Key Performance Indicators, or KPIs. These are common business metrics used to do what is called benchmarking. Measuring business performance. You compare your business results to a standard or a point of reference, to the industry, and to specific competitors. I'm going to introduce you to some of the more common ones segregated into the 3 types of business activities: operating activities, profitability on a steady-state basis, financing activities, transactions with lenders and owners, and investing activities, purchases and sales of assets and securities. Important KPIs for operating activities include profitability, which includes gross margin, net margin, and liquidity. Liquidity includes the current ratio, inventory turnover rate, and the receivable turnover rate. KPIs for financing activities include leverage, the debt-equity ratio, and the debt ratio. And owner's equity includes return on equity and earnings per share. Investing KPIs include investment returns such as return on investment and return on assets. The computations for all of these KPIs can be found at the link below this video. And that's how we measure performance. We benchmark results and review them on a regular basis. At this point, you have seen in a fair amount of detail what all needs to be done to quantify a business plan, one that maximizes business performance. You need projections going out 5 years, a break-even analysis based upon the owner's minimum budget, an in-depth industry and economic analysis, benchmarking using KPIs, and a review and monitoring process. This may seem like a lot at first, but once you get into the groove of doing this work, I think you will find yourself getting excited about building and growing a successful company. So, let me show you the spreadsheet model that I use with all of my clients to make this happen. It's called the Enhanced Strategic Model, and it's based upon another model called the Basic Strategic Model. Since the Basic Model is the foundation of the Enhanced Model, to save time, we will walk through the enhanced model of a sample company, and I will point out the differences between the two models. Then you can make a choice about which model you want to use. But before we jump into the model, let's walk through an overview for each one, starting with the basic model, the one with cash flow at its core, but without any assumptions feeding the cash flow tabs. In this model, you build all the assumptions from scratch and enter or feed them into the cash flow tabs. This is how you quantify the plan. At its core are the monthly cash flow reports for year 1 and year 2. This data automatically feeds years 3 through 5 using growth rates that you enter on the tab for each of the years. On the personal tab, you enter the owner's personal budget. This is the minimum budget we talked about, the break-even point. There is also a startup tab for year 1. You can enter sources and uses of funds here. There are also 2 tabs at the back of the file called Historical Income Statement and Historical Balance Sheet. These are tabs to be used to enter information for businesses already up and running, a place to do that trend analysis we talked about. And finally, there is one output report, a 5-year cash flow summary. Notice, only the core cash flow tabs are automatically connected. The rest of the data in tabs is independent. You must create your own links or data enter the information. Let's take a look now at how the enhanced model works. As you can see, the basic model is the foundation for the enhanced model. At the core are the same basic cash flow tabs. The personal budget is there as well. So is the startup tab, except it is called Source-Use, and it spans the first 2 years instead of just 1. The cash flow summary output report is there along with the historical income statement and balance sheet tabs. So, what's the difference? Bottom line, it's all about built-in assumptions. Let's look at them one by one. Let's start with debt for years 1 and 2. Here, you can enter loan proceeds, payments, and interest rates. Next is payroll. Here you can enter payroll month by month for 2 years in 3 different categories. Next is cost of goods sold, or COGS. This tab helps you build the cost per unit of your product or service. This data is fed to the monthly cash flow tabs and the inventory tab. There is also a tab for accounts receivable, where you can enter monthly invoices and collections for years 1 and 2. Changes in inventory and accounts receivable on a monthly basis feed the working capital tab, which feeds the monthly cash flow tabs. In this model, sales assumptions are input under the monthly cash flow tables based on units sold and price per unit. The personal budget feeds break-even data into the model, and there is an industry tab to collect information for benchmarking, which feeds the cash flow core. And finally, the output reports include a business plan, a cash flow summary, just like the basic model, and 2 other reports on separate tabs, a value report and an income statement forecast for 5 years. And that's how data flows through the enhanced model. Let's explore the spreadsheet models now. Before we get started, however, I suggest you print the 2 overview charts we just reviewed so you can compare these diagrams to the actual spreadsheet model. There are 2 links below this video, one for each overview diagram. Once we are in the model, I will show you the core tabs first, essentially the basic model, pointing out the differences between the 2 models along the way. Then I will show you the additional tabs that feed this core. All of the automated assumptions we just talked about. So keep those overview diagrams in front of you as we move through the spreadsheet model and take some notes. Also, if you haven't done so already, watch the video called Cash Flow Mechanics before you venture into the spreadsheet models. It will help you understand how a cash flow report works and thus what to expect in a projection model. A link for this can be found below this video. And now, let's take a look at projections for Jake's Bar and Grill restaurant so you can see how all of this works. We are in the model now on the Cash Flow Year 1 monthly tab. Notice all of the cells with different colors. Red means you can enter data in these cells. Blue means the cell is linked to another cell somewhere else in the file. And black generally means there is a formula in the cell. So be mindful. Only enter information in red cells. The word linked appears off to the left as a reminder that these cells are fed from another place in the model. Notice all the blue on this page. This is because assumptions are feeding in from other tabs. Cost of goods sold, interest expense, salaries, wages, and taxes. All of this is read in the basic model. You have to enter and calculate this information yourself. I want to show you one other major difference on this page between the two models. I'm going to slide down the page a bit so you can see that in the enhanced model, there is a revenue assumption table under the cash flow report where you can input the price for each product or service. Here's the price and the number of units. Here's the number of units that you expect to sell for each of these products monthly. This feature allows you to drive unit and price for products to a break-even level by changing the assumptions. Cash flow monthly year 2 works the very same way. We are in the Personal tab now. Here's where you enter the break-even budget information we talked about earlier. You enter income, excluding the income received from the business, and you enter all of the personal expenses you want to include. The enhanced model has been expanded to include 3 owners rather than 1, and it automatically feeds break-even information to the cash flow tabs. Otherwise, this tab works the same in both models. On the Source-Use tab, called Startup in the basic model, you enter the sources of funds and the uses of funds for 1 year in the basic model and for 2 years in the enhanced model. Sources includes financing in the form of loans. In both models, you enter loans and interest rates. In the enhanced model, however, you enter this information on a different tab. We also have the historical income statement and balance sheet tabs in both models. There's not much to see here because it's all data entry or maybe a copy and paste job from your financial records, so we won't go there right now. The last tab, common to both models, is the 5-year cash flow summary. First, notice all the number cells are in blue. There is no data entry on this page in either model. Everything pulls from the other cash flow tabs. The other item of interest here is the break-even analysis below the cash flow table. We can see here what the free cash flow is year by year compared to the personal budget. Note, this company doesn't break even until year 3. We can also see how many units per day the company must sell to achieve this goal. And that's the basic model. Let's talk about items now that are only in the enhanced viability model. We will start with the debt service tabs in this file. There are 2 of them. We will only talk about debt year 1 since the 2 tabs are similar. On this tab, you can enter information for 3 different loans. In this case, we have a bank loan for 60 months of $100,000. You enter the proceeds received, but the principal paid comes from another tab. Here's your second loan, an SBA loan, and here's your third loan. In each case, you enter an interest rate, and the model calculates the interest expense for you and feeds this information into the cash flow tabs. Let's look at 2 other new tabs now in the model: Payroll Year 1 and Payroll Year 2. We'll just look at Payroll Year 1 because Payroll Year 2 is the same. Here, you can enter 3 different categories of salaries: owner salaries, employees who are salaried, and if I scroll down the page a little bit, we can enter information for hourly employees. The model calculates the taxes and the benefits and pulls all of this wonderful information into the cash flow summaries. New again is a tab called COGS, or cost of goods sold. Let's go there. Here, you can calculate a per unit cost and a sales price for 4 different products and services for the first 2 years. Here you can see we're building the direct material cost for meals and for appetizers. Up above, you can see that information is pulling to calculate the cost per unit and summarize this information at the material, labor level, and gross margin. It gives you a gross margin percentage and a cost percentage. Let's take a look at working capital now. As a reminder, working capital is the cash required by a business to meet its day-to-day operating expenses, items that have not yet translated into cash. Basically, these are changes in the balance sheet accounts during any given period. The model calculates this number for you. For the first 2 years, it happens monthly, using information on the Inventory tab, Accounts Receivable tab, and current liability information right here on this Working Capital tab. Here are the changes for accounts payable, invoices processed, and payments made. Here are the changes for accrued payroll, payroll processed, and accrued payroll eventually that got paid during the period. Inventory changes can be found on the Inventory tab. The changes appear in each of the 4 different types of products or services that are being sold and processed through inventory. As you can see, here are the 4. Purchases are entered for each of the 4 different products or services. Cost of goods sold comes out of inventory based on margin information that you calculated on the COGS, or cost of goods sold tab. And finally, adjustments required in inventory are made every time a physical inventory account is done. Accounts receivable changes are calculated on an accounts receivable tab, very similar to inventory. Invoices for customers are input, and payments received from customers are input. And this is done for year 1 and for year 2. The Industry tab is totally new. This tab feeds reports in the model, and it also feeds the business plan. I'm not going to go through all the detail on this tab. I'll let you take a look at that on your own. I'll just hit on a few quick items here so you can see how this works. We've gathered information for a public company called Red Robin Gourmet Burgers. We also gathered industry information, lots of it. Gross margin, the EBITDA margin, and the EBITDA multiple. Those are the new assumption areas in the model where you can input rather than build assumptions from scratch. Let's look at the new output reports now. We will start with the Plan tab. It's the same business plan we talked about in our last session. As I scroll down, you can see that there's blue here. That means numbers are pulling from separate tabs in the model to populate the business plan. Down here, under the Viability Assessment section, there's lots of good information, lots of key performance indicators, and some comparative information to the industry. Now, you can write narrative around all this data. Let's look at the next tab now, the Value tab. Here you can see a range of value for the company. In year 3, using a 7.7 multiple, the company has a value of $278,000. In year 4, it goes up to $440,000, and by year 5, it's at $553,000. The original cost for the owner was $150,000. The next tab is the 5-year forecast of an income statement with industry information here and historical information if the business has been up and running. In this case, it has not. All of that compared to the projections for the 5 years that you just ran through the model. We've learned a lot today, but I have one more concept to introduce you to: running scenarios. Preparing a range of possible outcomes using the projection model that might alter your business assumptions and impact your business decisions. Bottom line, it's all about viability. Is the business sustainable? And that's why we run scenarios. I recommend at least 3 cases. A break-even case, using your personal budget as the target. A worst-case scenario, at least 25% less than break-even, and a best-case scenario, at least 25% more than your break-even case. You can run more if you want to, and I certainly hope that you do. But first, let me give you your homework assignments. It's all about how to quantify expected results in your business plan. There are 3 assignments. Complete all the required information. For assignment 1, complete the tabs for minimum budget, cost per unit data, and loan activity on the debt tabs. For assignment 2, complete the tabs for payroll, accounts receivable, inventory, and working capital. And for assignment 3, complete the sales and expense information required on the monthly cash flow tabs and all the narrative sections on the plan tab. You can mix them up if you like. Just remember, this is an iterative process, so take your time developing this plan. Live and breathe the story. And that's it today, folks. But before you go, 3 things. 1, write me a note below this video if you have any questions. 2, subscribe to the Butterfly's Paws channel so you know when a new session comes out. And 3, join VDOP at your local SBDC. If your center doesn't have one yet, then tell them you want one and have them contact me. Thanks, everyone, for listening today. I'll see you soon for another session together.